Wall Street took a hit last night with all three major indexes closing in the red. The Nasdaq fell 2.01% to 25,409.66. The S&P 500 dropped 1.18% to 7,318.63. And the Dow Jones Industrial Average declined 0.64% to 50,466.87. Technology and high-valuation growth stocks led the decline. The Nasdaq 100 ETF fell 2.03%. Nvidia dropped 1.96%. Tesla slid 3.78%. And the ARKK Innovation ETF lost 3.1%. Notably, MicroStrategy plunged 7.43% while the Bitcoin ETF dropped 3.05%, moving in sync with Bitcoin. There were no verified abnormal individual stock moves yesterday as all stock and ETF movements stayed within 8% in absolute terms. This market decline is a systemic risk aversion contraction rather than a single event-driven move. Futures are extending weakness in pre-market trading. Nasdaq futures are down 2.27%. S&P futures are off 1.24%. And Dow futures are lower by 0.64%. This suggests pressure will continue when Wall Street opens tonight. Looking at global macro conditions, the 10-year U.S. Treasury yield stands at 4.55%, down 0.09%. The yield decline reflects safe haven flows into bonds, but the absolute level remains high above 4.5%, which continues to pressure liquidity-sensitive tech stocks. The VIX Fear Index rose to 19.62, up 3.7% from the previous day. It sits in the normal to elevated range of 15 to 25 and has not yet entered panic territory above 25. But the upward trend shows market anxiety is intensifying, with sentiment sliding from normal to cautious. The US dollar index stands at 99.85, down 0.12%. The dollar remains weak, extending its recent downward trend, which provides some support for emerging markets and commodities, but the impact is limited. WTI crude oil is at $87.86 per barrel, down 2.52%. The decline reflects growing concerns about slowing global demand as the earlier OPEC+ supply disruption premium fades. Spot gold is at $4,303 per ounce, down 1.3%. Gold pulling back from highs despite lower treasury yields and a weaker dollar suggests the market is actively deleveraging rather than simply seeking safe havens. This is a clear risk-off signal. In summary, the global market is in a clear risk-off state. Broad-based U.S. stock declines, a rising VIX, a Bitcoin plunge, and gold pulling back all point to capital fleeing risky assets. The condition for reversal would be if S&P futures turn positive and break above 7,400, or if the VIX drops below 18, which could trigger a brief risk appetite recovery. Now let us turn to the renminbi and China asset external environment. The onshore dollar-yuan rate stands at 6.7714 while the offshore rate is at 6.7756. Both have appreciated slightly. The renminbi has strengthened recently, moving from the 6.85 area back to around 6.77. This persistent appreciation pressure was a key external support for the A-share market independent strength yesterday. A stronger renminbi reduces capital outflow pressure and improves foreign investor preference for Chinese assets. On the trade and technology friction front, there have been no new major developments as of today. Both sides maintain existing measures with no escalation or de-escalation signals. For today, A-share market opening sentiment, we expect a flat to slightly lower open. The reason is that yesterday's sharp rally with the Shanghai Composite up 1.28% and the Chinex up 3.93% has built up short-term profit-taking pressure. Combined with continued weakness in U.S. stock futures overnight and a rising VIX, this will weigh on opening sentiment. However, the renminbi appreciation provides a buffer limiting the downside. If the FTSE A50 futures rise more than 0.5% before the open, or if northbound capital inflows exceed 20 billion yuan in the first 30 minutes, the market could turn to a higher open. For the A-share market today, the Shanghai Composite after yesterday's strong rally will likely consolidate with a weak bias. The Chinex due to its higher beta may see a pullback. Support for the Shanghai Composite is at 3,950 with resistance at 4,040. For the Chinex support is at 3,850 with resistance at 3,980. The most likely active sectors today are utilities, power and consumer staples. The reason is that in a global risk-off environment capital tends to favor defensive allocations. Utilities offer both high dividends and low cyclicality with no significant recent gains providing a safety cushion. Consumer staples including food, beverage and pharmaceuticals are often bought during risk aversion. If renminbi appreciation drives foreign inflows, consumer leaders may also attract interest. For risk management, we recommend avoiding semiconductor and AI hardware computing sectors. U.S. tech stocks led the decline overnight with Nvidia falling and others likely to follow. Combined with no relaxation in U.S.-China technology restrictions and a share, tech stocks having already rallied significantly yesterday on the broader market rebound, these sectors face dual risks of profit-taking and external pressure today. Gold-related stocks should also be avoided in the short term. International gold prices fell 1.3% and a share gold stocks have already risen for several consecutive days, so profit-taking may emerge. On northbound capital flows today, the probability of net inflows slightly exceeds net outflows. The core logic is the renminbi is in an appreciation trend with the dollar weakening and the yuan strengthening, making Chinese assets relatively more attractive in the global market. However, we need to be cautious about the negative impact of last night's U.S. stock sell-off on risk appetite. The key signal to watch is northbound flows in the first 30 minutes. If net buying exceeds 10 billion yuan, the probability of full-day net inflows is high. If net selling exceeds 15 billion yuan at the open, it could turn into net outflows for the day. One-sentence core judgment: the renminbi appreciation supports a shares, but continued weakness in U.S. stock future suppresses risk appetite. Today we'll see a weak consolidation with defensive positioning dominant. Probability assessment: 25% up, 45% range bound, 30% down.